Hello, everyone, and hello, Paul. Thank you very much for joining us. So I'm very excited about our podcast today. We're going to be discussing something very, very cool. Before we start, just the usual disclaimer that none of this is financial or investment advice, and this is purely for, degen, education, and entertainment. So with that, Paul, welcome to the podcast. Please, introduce yourself, tell us what you're working on, and how you got into crypto.
Yeah, thank you very much for having me. I'm Paul Frambot, CEO at Morpho Labs, and I'm working on Morpho, a DeFi protocol that we'll have plenty of time to discuss. But basically, came into crypto in 2016 with first being interested in consensus algorithms and started going up the stack and moving from consensus algorithms to Ethereum virtual machine, and then finally to DeFi. And I'd say in 2019, 18, I was like, DeFi was quite a pain to use. We were a lot into peer-to-peer protocols where basically the experience was very hard. At the time, you did not have Uniswap, you did not have Compound, or it was barely known. And in 2020, I really got into the compound lending pool theory, and I had this research group where we had fun modeling the whole thing. And from this workshop came out different ideas on how we could make a protocol that leverages all the advantages of this lending pool model that is present in Compound or Aave, and make it an even more efficient protocol that relies on all the liquidity of those existing protocol, which is Morpho. But we'll have the time to discuss it. And since then, I've been working on Morpho since the summer 2021. We've been raising funds, and a few days ago we went live, so we're very happy about it.
Yes. Well, very good timing for the podcast then.
Yeah, absolutely.
And so obviously, yeah, we'll need to dive into what Morpho does, but I guess speaking about DeFi more broadly, obviously it's been very turbulent few weeks, to say the least, for DeFi as an industry. And overall, it seems that DeFi has lost a bit of its spark because, as a kind of very active DeFi participant, I can also kind of, with pain, agree that kind of the innovation wave has slowed down a little bit. So I'm curious, how do you see DeFi evolving more broadly? Should it exist, or was it just a kind of derivative of a speculative bubble? Do you expect real applications? Like, how do you see DeFi evolving in terms of new projects coming and real adoption coming? And then what does it need and what is it missing?
Yeah, okay. So I think that indeed, since 2020 and 2021 with Uniswap, like the main innovations at the time were the pool model, right? You have a liquidity pool for DEXs, or you have a lending pool to lend and borrow crypto assets. And those were really truly innovating projects that really triggered this DeFi summer. And that was basically the innovation that sparked the enthusiasm around DeFi. And from this spark, gave birth to many protocols. And I would say lots of the innovation we've seen in 2021 and the end of 2021, beginning of 2022 was a lot about token engineering or token mining, and especially with curve wars and everything. But I'm not saying this is not innovating stuff, but I'm just saying that we're innovating in the incentive model rather than in the base layers of DeFi, right? Of course, you had Uniswap v3 that is, bringing very fresh concepts. It's already been a year, but it's really clever mechanisms that bring efficiency in DeFi. But we kind of, there are innovations, but we did not have the spark that we had basically for DeFi summer that triggered this whole new range of innovation. And I believe that it had quite an advantage, is that you have all this VC money coming for young entrepreneurs, basically building, innovating stuff. Most of them will probably not survive, but the good thing is that you have a lot of long-term innovations that are being built, and maybe one of them will be the spark to basically trigger again an equivalent of the DeFi summer and taking DeFi to the next step. Okay, we've been talking a lot about DeFi 2.0 the last months, but I don't think it really ever happened. We talked about DeFi 2.0, where you could basically get a token from a protocol and put it into another protocol to put it into another protocol, etc. But sometimes it does not make a lot of sense. And the innovation is not here. It's just about accumulating layers of yields, which is not necessarily a bad thing, but it's not about improving the efficiencies of protocols or innovating. It's more about, gaming the system to take advantage as much as possible of the rewards, and bootstrapping as much as possible the number of users, etc. So yes, now that the market has been done in the last weeks, approximately since the Terra Luna event, I believe it's really like the time for a more rational approach to DeFi and say, okay, what's actually generating yields? Where does the yield come from? And actually, the question, where does the yield come from, is a really good question to ask yourself when you're coming into a new DeFi protocol. And when the token are down, you can see that most of the yields can go down, of course. And so it has kind of the natural selection effect of only showing protocols that can survive those conditions and those protocols that are truly innovating in some way. So to some regard, I kind of approach this bear market, if we can talk, of course, about the bear market, quite positively, as it's kind of will help us discover what are the new innovation out there.
So sounds like there is still some hope yet on the horizon.
Yeah, absolutely. So when you look at the different projects that are funded by top VC companies, especially funds that are based on research like Andreessen Horowitz or Paradigm or those kind of funds, you see that you have really like completely innovative ideas in terms of DEX, in terms of lending, and truly believe that the next wave of DeFi will be triggered by one that is approaching DeFi differently. Mm-hmm. And that will definitely unlock this new era of growth for DeFi.
So I completely agree, right? We needed this cleanup to happen. The cleanups are always very, very painful, but the real innovation is still here. And now we just need to go to the next phase of that evolution. So if we now circle back to the kind of peer-to-pool model that you mentioned, that sparked DeFi in the first place, what excites you about it, and how does Morpho turn it, kind of on its head?
Yeah, absolutely. So, well, the pool model that was introduced, I mean, for lending pools, so the model that was introduced by Compound some years ago is basically about having everybody providing its liquidity into the same pot and basically waiting for someone to borrow so that interest generated by borrowers is going to be split among all lenders. And it's a model that you don't really have so often in traditional finance because it's quite inefficient in the sense that you share rewards. Okay, in traditional finance, you have more kind of order book approaches where basically you place an offer and you receive a match for this offer. And the reason why it was not working in DeFi is because this model is not scalable to suit the constraints of a blockchain. Okay, so what was really magical about Compound is that it could fit a whole lending algorithm in a very low complexity and in a very seamless approach, in a very seamless experience for the user, right? You supply your liquidity, you earn yields instantly. You want to withdraw your liquidity, you can withdraw it instantly, almost infinite amounts. And that's quite crazy. And it fits really the constraints of the blockchain. So that's very nice. However, it has, of course, inefficiencies. Okay, and actually, those inefficiencies are very visual. Okay, if you go to Aave or if you go to Compound websites, you look at the lending rates and you look at the borrowing rates, and you see that there is this huge spread between the two. And we're talking about 2% spread in average. And it's really you look at your ETH is earning 0.1%, and you look at in lending, and you look at the borrowing side, and it's paid at 3%. Okay, so you have this huge spread, and one may ask, but why is there a difference, right? And the difference is actually coming from the lending pool model that we were talking about. So you have many lenders and very few borrowers. And borrowers are going to pay more in order to subsidize the rewards that are going to be shared among all the lenders. And basically, you get the idea that yields are kind of socialized in all this. And one may ask the question, could we make this more efficient? Because basically, if I'm lending to you some ETH at, let's say, 1.5%, and then you borrow it at 1.5%, we both get better yields, right? Borrowers are getting lower yields, and lenders are going to get higher yields. So that's super fine. And I mean, that's some sort of an improvement for the two of us without losing anything. And this is basically what Morpho is about. It's about introducing a peer-to-peer layer that is going to match users peer-to-peer and have them enjoy this rate of 1.5%, so which is a rate that is in the middle of the spread. And it's about seamlessly introducing this layer of improvements that does not change anything to what basically compound is or what Aave is. And when you have Morpho compounds, you basically have an improvement of compound. So you can be in the pool, okay, that's the sort of worst yields that you could get, which is already quite good. And then you'll be matched peer-to-peer whenever there is a borrower coming from Morpho or a lender coming from Morpho that is going to match your position. So in short, Morpho introduces an improvement layer thanks to peer-to-peer matching, whilst preserving all the benefits of the compound pool of the Aave pool. Okay, so mainly three things. Okay, first you have liquidity. Okay, so if you want to borrow 1 billion on Aave, on Morpho, sorry, you can borrow 1 billion from day one, right? Because we're relying on the liquidity of compound or Aave. Okay, so you can do it from day one. If you want to withdraw your liquidity at any time, you can do it. Okay. Now, in terms of liquidation, Morpho compound is going to mirror the exact same parameters as compound. So it's the same liquidation experience. Okay, same collateral factors, same close factors, and other liquidation parameters, and oracles as well. And then about rates, which is the third point, you're going to experience improvement thanks to this peer-to-peer matching. So I hope that's not too much in the same block, but the idea is that you get the same experience, but with improved rates.
So it sounds like it's basically an optimization layer that sits on top of the peer-to-pool model, right? Making it more efficient.
Absolutely.
And why hasn't it been done before? What's your gut feel about that?
Yes, so there are different reasons for that, in my opinion. The first reason is that it's actually quite complex to do. Okay, it's not so trivial. We've been working on it for a year. Okay, and throughout the year we have a full team of 12 persons. 10 of them are engineers and have been in DeFi for a long time, or in formal proving or blockchain engineering for a long time. And the challenge here is basically to build a scalable order book. What do I mean by that? Is that you have those peer-to-peer matching, but peer-to-peer matching are great because that's a huge efficiency, actually the maximum efficiency that you can get. But you have two problems. You have gas problems because it's gas costly, and you have liquidity problems because potentially, like if you don't find a match, you need to find the liquidity. Okay. And so the challenge for us was basically to design a system that would be able to use the pool in case we have one of those problems. So the intuition is the following, is that when you go to Morpho, we'll try to match your liquidity as much as possible. And if we see that you have too much gas used, then we fall back into the pool and we finish the order into the pool. And if we don't succeed in filling your complete order in peer-to-peer, then we complete the order with Compound, for example, which is going to be the lender of last resort or the borrower of last resort.
Mhm.
So this is some sort of way to have a complex algorithm, but has a finite or a bounded complexity thanks to Compound. So to that regard, it's very interesting. And maybe to get a feel, an example of how this thing would work, I'll just give an example to see that it's not trivial to have this fallback. So for example, I'm lending some DAI. Okay, let's say I'm lending 100 DAI, and let's say you put 1 ETH as collateral, and you're borrowing 100 DAI. Okay, so we are on Morpho. So basically, what the algorithm is going to do is going to match us together, and we are going to enjoy an optimized yield. Okay, that's great. We're very happy with that. And what's going to happen is that you go offline, and I want to withdraw my 100 DAI. Okay, but basically my DAI is not here because you borrowed here. You borrowed it. And so I have to find a way to basically have the liquidity, the 100 DAI automatically. And without getting too much into details, the intuition here is that Morpho is going to use your collateral to take a loan on Compound and give me the liquidity. So it's kind of a tricky fallback mechanism that is quite complex to design in practice, but it works beautifully fine, and I can withdraw my liquidity at any moment, even though I benefit from a 100% efficiency of my liquidity.
So then it's like a bank of banks, right? So you aggregate all the lending, because theoretically you can have Compound, you can have Aave, you can have Euler, or any other lending marketplace, and then you can effectively route the orders across the different peer-to-pool lending marketplaces. And on top of that, there is a peer-to-peer component. So theoretically, does this mean that you can find the best path, so to speak, for an interest rate bid-ask effectively? Is that the right way to think about this?
Yes. So maybe let's distinguish aggregation and optimization. Okay. So you have different lending pools, and each of them is going to be improved / optimized by Morpho. So let's say you have Compound, then you have Morpho Compound sitting on top of it. If you have Aave, you have another protocol, which is Morpho Aave, and you have an optimization layer that is sitting right on top of the lending pool. And then you could completely imagine a router that is basically saying, okay, you have all those Morphos, Morpho Compound, Morpho Euler, Morpho Aave, and then you have a router that basically says, okay, you have aggregated and optimized yields over the whole DeFi, which is very cool because in all this, there are no, this is just pure optimization. There are no rewards. We have not talked about rewards or incentives or token economics in all this. This is just pure mathematical improvements of the current DeFi state, which is very cool.
Yep, I understand. Makes sense. I mean, we can make assumptions about what the future might hold, but clearly it's an optimized solution as it is. And what about credit risk? So obviously places like Compound, they have liquidation bots where if there is a default in the pool, there is someone who is connected algorithmically and they can liquidate bad debt in the pool and therefore basically meet a margin call requirement. How would it work with a peer-to-peer model?
Yes, so the short answer is it's exactly the same. But to get into the details, as I mentioned a little bit previously, Morpho is going to mirror the different parameters that are used for liquidation on Compound. So Morpho Compound has the same collateral factor, the same close factor, which is a less known liquidation parameter, and the same oracles. Okay, all of this is mirrored on chain, so that the liquidator experience is exactly the same on Morpho Compound than what it is on Compound. So if I'm a liquidator and I start liquidating positions on Morpho Compound, then it feels exactly the same as if I was liquidating on Compound. And basically, Morpho was designed in order to replicate the exact same credit risk for this. And it's really about preserving the experience, preserving the liquidity, preserving the credit risks that you have on Compound. And we don't touch that. And on top of that, we add a pure improvements. So yeah, and for that, how it works technically is that you can basically ping a Compound liquidator and tell him, now you can also liquidate on that address and use basically the same algorithm, and it works the same way.
That makes a lot of sense, because obviously being a liquidation-friendly protocol is very important. I don't know if you saw, there was an interesting dashboard published recently. I think it's called Risk DAO or Bad Debt DAO, basically Risk Dashboard, where it shows that you have different protocols with bad debt. And
yeah, absolutely.
Enough, kind of the ones that have the highest reputation, they have very little bad debt. There was one specific protocol on Aurora. I think they have 200 or 300 million of assets in the lending pool, and they have 47 cents of bad debt, which is not a bad ratio, I would say.
Yeah, definitely. I remember in the early days, I think it was Maker that was manually liquidating positions that were not profitable at all, because there were not liquidators to actually do this, or gas wars basically made it really not profitable to do so. I think it was Maker. And yeah, so definitely an important thing to consider when designing a pool that requires this sort of hard workers and bots that are running on top.
Absolutely. And, you know, as you think about optimizing everything when it comes to the yields and to the costs, I'm curious how you think about what blockchain layer you want to be deploying and then scaling up, because I mean, I'm personally a huge believer in the Ethereum ecosystem, and even in our Re7 kind of activities, we notice that 3/4 of what we do is still on Ethereum, and not even though we're able to do many different chains. But it is fair to comment that Ethereum has lost some market share over the last year as percentage of total assets in DeFi, which on one hand is not really a problem, because the assets, well, at least prior to the crash, have scaled up by 10x, right? So the market has grown 10x and they captured a lot of that anyway. But how are you thinking about deploying on Ethereum, which has relatively high gas costs, or high gas costs without the world relatively, but has probably the biggest and the most active DeFi community, versus going into some other layer ones or layer twos? What's the right trade-off for you know, a founding team like yours?
Okay, so it's definitely an interesting question, because as innovation are pushed further, they often require higher gas costs, to be honest. Like we've seen some derivative-based stablecoins, for example, that have a slightly higher gas cost than others. Like when you start innovating, at some point you need to add complexity to your protocol. So you need a little bit of gas cost. So the whole point for us when designing Morpho is that whatever the blockchain is, you have to design, at least in the first place, an algorithm that operates with a constant complexity. That is very important, because order books do not have a constant complexity. It can go very, very high. And so you have to have an algorithm that does everything in one shot, right? And you can't have those endless for loop that can loop into an out of gas exception or very, very high gas costs. So in the case of Morpho, we really had a hard time designing a protocol that could basically fit into a constant complexity. And it's basically done, as I mentioned, with thanks to the fallback on pool. But the cool thing about it is that we can basically set the gas costs of Morpho's operations. What I mean by that is that the more matchings, the more efficient we want the peer-to-peer layer to be, the more gas we can authorize for the operation. And this is quite interesting, because if you deploy on other chains that are more that enables more efficiency, then Morpho becomes even more efficient because you can do even more peer-to-peer matching. So if we were to switch to Polygon, for example, the sort of low gas cost of Polygon would enable Morpho to basically have more complexity and thus more matching, and there's more efficiency in terms of liquidity matching, which is very cool. So for us, we were really thinking in terms of Ethereum is the main layer. We have to be here because it's kind of where all the big liquidity is standing and also the most secure layer. But other chains are very interesting in terms of innovating. Like Morpho could be deploying the full extent of its matching engine on other chains and prove that it can go even further in the optimization on side chains, which is very exciting because we basically design an algorithm that can be adjusted according to the chain it is in. But more generally speaking, and not about Morpho in itself, like as a founder, I think the choice of going to Ethereum is, unless you're really innovating something that can't be put on Ethereum, I think it's like you have to start with Ethereum, in my opinion, because I think there is a lot of trust into the chain, and also it's really replicated on the protocols that are on it. So if you have a protocol that is only on, for example, Avalanche or the BSC or Polygon, it won't be as trusted as the Ethereum-based layer. And without any subjective consideration of other chains, I'm just saying that this is the way the ecosystem reacts at the moment, right? If you're not on Ethereum, then you're not presented the same way, or you're not as serious than the other protocols. And this is not something we have to choose. This is just how it is at the moment.
Yeah, I completely agree. Part of it is probably a bias, but also it's battle tested, right? We've seen
absolutely.
We've seen some liquidity pools just, I think, this week on one of relatively new blockchains being attacked, and the whole chain was kind of thrown in some state of perplexion, so to speak. So I think people by now realize that smart contract risk is real. They have definitely now realized that the stablecoin risk is real. But I think people have a little bit forgotten that the blockchain layer risk is also real, right? That you, if you're like as liquidity providers, we need to think about and dealing mainly with stablecoins, we have to think about the stablecoin risk, the smart contract risk, but also what are the chain we're putting our capital onto, because maybe it was created yesterday and maybe we shouldn't be putting any money there. So it's important to keep that risk in mind. And I agree that Ethereum is by far the clearest leader. And yeah, personally, we're seeing all real activity. Well, not all, but most real activity happening there.
Absolutely. And I would like to underline something that actually I've never considered as a liquidity provider, the blockchain risk, but that's definitely something that should be taken into account. And there is something that I learned when doing my research and studies in consensus algorithms, is that most of them are not proven, right? Most of them work empirically, and we don't know the thing about the liveness of the safety. We have a lot of parameters like the liveness quorum, the safety quorum, etc. But it's such a complex subject that very, very few people understand it, and there are mistakes. There are plenty of mistakes in research papers and formal proving as well. And it's honestly quite scary when you research it a little bit, because it's hard to find a chain that really has a scientific approach and that is at the same time innovating, but also battle tested. So it's really, really, really hard. And it's a personal opinion to think that in the next decade, we might see a blockchain basically being completely desync and putting at risk all the funds inside the chain because of the consensus algorithm, because it's so not well known and so little, it's not really considered by users, right? Because it's so complex that people don't really assume that it's working correctly, but it's really not the case always.
Yeah, I couldn't agree more. Thinking about this in long term, so clearly the optimization layer that you're introducing makes it pretty much a no-brainer for example, people like us or other existing DeFi market participants to you to lend, borrow, and provide liquidity on your platform, especially as it evolves. In the long term, what do you see would be the killer app for Morpho, and I guess as a consequence of that, the whole lending business in DeFi? What needs to happen for, like, so because clearly you can win a tangible market share of the current kind of TVL in the space, right? And then if DeFi does well, you will kind of grow in line with that. But what would be the one single thing that can really kind of push your growth to hockey stick trajectory?
Yes, I think for Morpho, so we have different products in mind, but the first product we've released in itself, in my opinion, which is of course biased, is a complete no-brainer for lending, right? There is no reason why you would not go to Morpho Compound if you're already on Compound, because you're basically earning more efficient, you have more efficient capital, and you preserve the liquidity and you preserve the liquidation parameters. And to me, Morpho is more about an educational problem. We have a protocol that is complex, okay? We have research papers that are 80 pages long. And of course, no one is going to read it as a retail user, for example. And it's all about educating people on what we're doing, what's better, and why they should care when they're lending funds or when they're borrowing funds, because they're going to basically save a lot of money or earn additional money thanks to this. So I'd say that the first pitfall that we have is an educational problem and get people to understand what we're doing. But then if I had to state maybe one design that I expect DeFi to basically have in the long term, is basically coming back to order books in some way. In my opinion, order books are mathematically the most efficient way to think of money transfers or money operations rather than transfers, operations. And as we said in the beginning, the blockchain constraints don't allow order books. But what if we combined the order book with the pool model in such a way that it becomes fully scalable, right? And what if we had more and more strategic market makers, for example, that are going to be very active in the liquidity management of those order books on-chain directly? And yeah, so to me, that would be like the end game of DeFi, is starting to build back those order book in such an efficient way that it's unbeatable compared to current models, in my opinion.
That's not an easy task, but it's we already see some early innovation in other books. So I'm, if DeFi got us to where we are today in just a couple of years, I think what you're describing is absolutely achievable. Yeah, absolutely. So there are a couple of challenges to that, of course. For example, the first challenge is, what do you do with your liquidity that is placed as an order? So you have to place an order, but of course you want your liquidity to be working at the same time. So maybe not put your liquidity, but maybe promise your liquidity and put it somewhere else until someone actually matches it. So that's maybe a first challenge and a draft of an answer to this challenge. Another challenge is gas costs. How do you scale those gas costs? So one answer could be other chains at first until Ethereum enables its scaling solutions. But other answers could be closing the complexity of the order book thanks to liquidity pools, for example. Basically, a little bit what we're doing, but in a very much more primitive way. Well, you're just getting started. Of course. So apart from Morpho, what is the one single thing you would highlight that excites you about DeFi and maybe crypto more broadly? What's, in my opinion, very, very exciting about DeFi is that basically how much better I always realize DeFi is compared to traditional finance. And every day I wake up and I say, but this thing, DeFi as a whole, is a complete no-brainer for the whole financial system in the next decade. And I'd say 3 reasons for that. The first reason is that it's very, very simple, but it's just a question of infrastructure costs, right? You have thousands of banks
each of them have their buildings, they have their security audits, they have their marketing team, they have their, and you get all those very precious and cost-heavy resources, and you multiply them by the number of banks. Okay, here we're thinking of a complete common base layer, which is Ethereum, so no infrastructure costs at all. And we're just talking about building the algorithm, which is basically a common good, right? It's open source. Anyone can contribute. And instead of having 1,000 different algorithms that are closed source, you have one single algorithm for the whole humanity. And in terms of cost reduction, is like, wow, this is crazy. Like, we're not going to pay those 1,000 useless costs. So in the end, it will, for the end user, for the lender, for the borrower, for the swapper, and whatever financial operation you want to make, this is going to appear in the end. You know, when you see the rates, this is going to be improved. And this is what's very exciting, because the end game of all this is really to you have this revolution of our financial system, and basically enable not only something that is permissionless, open, transparent. Those things are amazing, and but I would like also to insist on the fact that it's going to be much less costly for users. Like, basically, Bitcoin and Ethereum are ways to transfer money abroad for nothing, right? You could send $1 billion from one country to another for $10, which is, I mean, there is no service in traditional finance that is close to get those prices, of course. So yeah, even as a company at Morpho Labs, we use DeFi in our everyday life. Like, we raise funds in crypto in a Knossos multisig. Okay, we did not ask the permission to create this Knossos multisig. We just have it, and then we pay employees with request finance that basically invoice us in crypto. We pay them in crypto, and then they do the shopping and stuff with most of it is done in crypto already. And if we want to switch from US dollars to euros, for example, we can use Curve, which is much more efficient than basically the rates that we would have had in traditional finance. And we use a euro stablecoin, like mostly Jarvis euro or Angle euro, and we pay contributors by that. And the overall cost that we have, we're not using crypto because we're crypto native. We're using crypto because it's better and because it's less costly for the company. And to me, every day, this is blowing my mind. And I'm like, okay, this is really something that is so cool. And that's going to enable such a savings for every human, and is basically going to empower every human, in short.
Yeah, well, I very much agree with what you I couldn't have phrased it better myself. And every day, every time I have to go and queue in a bank to to do whatever, I just think back about the beautiful Curve, and everything around that. So yeah, I definitely agree with you. So before we wrap up, is there one kind of final thought or message you would like to leave our users with when it comes to Morpho?
No, I think I would encourage to digging into it. We're not looking at mercenary liquidity. I would never encourage people to actually use Morpho without understanding why it's actually better and what's the point of using it. So I would definitely encourage at going to morpho.xyz and basically look into our white paper, for example, or look at the website and understand the concepts behind it. And then if it makes sense to actually get an improvement of the compound or other yields without losing liquidity, without losing liquidation parameters, then of course they can give it a try. But I would definitely encourage people to, as we say, make their own research on the protocol, because I truly think this is an interesting concept that is nowhere near, like, there's nothing quite like it in DeFi at the moment. I've never seen protocols exploring the same ideas that we've been exploring. And I think it's quite refreshing concepts. And when we've been audited by Trail of Bits, the guy said at the end of the audit that it was such a refreshing protocol to audit, because it's quite different from others. It's not a lending pool. It's just a peer-to-peer layer type of thing. So I would strongly encourage to educate yourself on the protocol.
Sounds very wise. Cool. Well, thank you so much for joining. I very much enjoy this, and obviously, I completely agree with what you've said. I think it makes a lot of sense, and the value is pretty clear whether you are, well, basically any type of DeFi market participant. So, wishing you all the best with your recent launch. I'm sure it's going to be great, and then I'm sure we'll do this again sometime. Thank you,
Okay,
listeners,
thank
to
you very
everyone for
much.
listening, and thank you, Paul.
Bye.